a comparison here with an actual moving average. The predicted moving average that you'll see there is that blue line, and as you can see, there are a couple of distinctive things about that blue line as compared to that black line you see on the screen. The black line is the actual moving average based upon the close. Again, just to emphasize the point, the blue line is based upon typical prices. So we have a moving average. It's kind of one of the base indicators that we're going to be used in our long-term analysis. When you look at that blue line, you will see that there are some things about it. It starts to turn a little before the black line. It makes some crossovers, and the crossovers will provide a signal that we're going to be talking about in a little bit. Now we want to add a couple of other indicators here just to round out what we have available on Vantage Point, because again, we need more indicators. We need good indicators to tell us what point is the point at which we will enter. I'm looking in here. We added two more here on the bottom. The gray line we'll talk about first, and this will be less of a play, but you want it to be on your side. But the indicator that we have there is the Neuro Index. It's called a predicted Neuro Index. This is a comparison of two 3-day moving averages, a predicted moving average and an actual moving average. And the forecast that you get is that in 2 days, the market will be higher, the typical price will be higher than it is today. If that's the case, you will get a reading or a rating on that of 1, which you can see right here. This is a indication of 1, which is a bullish sign. A long-term scheme of things, it may not be something that will be that significant, but it is significant if you want to get into a market, get into it at the right particular point. On the bottom side, if it's a weaker situation that's coming up in the next 2 days, according to the Vantage Point analysis, the reading will be 0. So that would be bearish. A couple of things that we're going to look at on here relate to both the predicted moving average, which is that blue line on the top portion of the screen, and the predicted differences on the bottom part of the screen. The first thing that we're going to be looking at is the general angle of those lines. As you can see on here, we have a situation, it may not need a lot of explanation, but you can see here that we have a situation where the blue line is angled up, and you have a situation where the predicted differences are moving up. I probably should explain the predicted differences a little bit. The predicted differences are the difference between the predicted moving average and an actual moving average. And they're shown this way because it has a little more visual representation of what is underlying the market. Where's the momentum? Is it starting to pick up? Is it kind of weakening? It's a very good indicator of what is coming, potentially coming in the predicted moving average, moving up and starting a trend. In addition to the angle of those lines, another thing that would be interesting to note about this is where the crossovers occur. The blue line, again, is a medium-term moving average. It is crossing a long-term moving average. It's actually a difference, I should say, where the medium-term difference crosses the long-term difference. That's an early alert. In this particular case, it isn't maybe not a big surprise, but you will have these little times where you have these little fits and starts. Had a little fake out move here, so it's hard to get into a trade always right at the very bottom of every trade and always be right the first time out. It may take a time or two, or you potentially will catch a move that is worth trading. One other thing besides the angle of the lines and the crossover situation that is worth pointing out on this particular chart is that we had a kind of an interesting situation in that prices moved lower. And you can see that when prices were moving lower, at the same time, the predicted differences were moving higher. That's a concept that is called divergence. Usually when you have types of divergence, you will tend to go with what the indicator says because it has kind of an underlying sense of what is happening in the market, and it does not necessarily assure that it's going to follow what the indicator says, but if you have to place a bet, often it's best to go with what the indicator tells you rather than what the price data itself, the flat price data, tells you. Now these indicators are very helpful for getting a kind of a sense and a tone of what the market is going to do, where it's going, kind of is it going up, is it going down? but it isn't necessarily the best for giving you some precise points at which you want to trade. So we're going to throw in another indicator here, and I don't want to clutter up the screen a whole lot, but it's important to get these things all together to take a look at them and to see how they interact and how they kind of reinforce one versus the other. And that indicator is the predicted high and low. Vantage point predicts the next day's high, the next day's range, and that gives you a kind of a channel within which to work and to expect the probabilities of where the prices will be the next day. The orange line or the gold line, depending on how the kind of tone you have in your computer, is the predicted next day high. The pink line is the predicted next day low. And you can see that forms kind of a channel, kind of shows you the predicted range for a given day, and that's the range that you're going to be using to make some trading decisions based upon some specific criteria, some specific points. In this case, what we're looking at is we kind of made an arbitrary judgment here, and it may or may not be something that would fit you, but we're making an arbitrary judgment that we want our market to go up $2 from the predicted high before we'll enter. And the reason for that is we want to leave a little leeway there because we frequently have these little occasions where we have jabs and we have little things that go on in the market that you know, we need to be a little bit careful about getting caught and getting caught too many times, and we'll have to do that with some risk control. For example, we had a situation here where we had the market pop up, would have barely gotten us into a trade that would have not turned out to be such a good trade, but that's, as they say, it goes with trading. It's par for the course. When you're talking about trading, you're going to have some situations where you're going to have to ride through some losses before you get to the winners. In this case, we are looking at the candles that we have here. Are we're going to look at, emphasize, starting with this one right here, which is on July 13th. As you recall, we said we didn't want to really go back before June because it took a little while for people to get kind of back into some kind of sense that the markets do work, that they do go up, that we don't get all discouraged and all that. So we're going to say that we're going to start with our June, and this is really our first opportunity other than that fall start that we had. And on July 13th, the predicted high was 75.91. That's this area right in here. 75.91 was our predicted high. So if we put our stop, we're going to be a buy stop, we're going to buy $2 above that predicted high, and that would put us in at 77.91. I don't know if I have this in the precise exact right spot, but we'll say that the goal is that we are in the market 77.91. Now, the natural stop here, as I mentioned earlier, we were talking about going below that low because we would like to be, we would like that market, we'd like to have a little staying